the disappearing fortune. In a single year, Elon Musk lost roughly $130 billion, not from a failed casino bet, not because Tesla went bankrupt, and not because $130 billion was ever sitting in a bank account waiting to be withdrawn. That's more than the annual economic output of New Zealand. It's enough to buy Ford and General Motors combined, with tens of billions left to spare. But Tesla did not disappear. Musk did not declare bankruptcy. So where did the money actually go? By the end of that year, Bloomberg's Billionaires Index would record one of the largest personal wealth declines ever tracked for a single human being. What follows is the chain reaction behind it. Rising interest rates, a reckless side purchase, a stock market losing patience, and a future Tesla had promised, but not yet built. Because underneath the cars and the stock ticker, this was never really a story about vehicles, it was a story about belief and what happens when belief gets repriced. The peak, when Tesla looked unstoppable. Rewind to November 2021. Tesla's stock had just hit an all-time high, and Musk's fortune had climbed past $340 billion, according to Bloomberg, making him, by a wide margin, the richest person alive. Investors weren't just pricing Tesla as a car company, they were pricing it as the company that might dominate electric vehicles, battery technology, autonomous driving and robotics all at once. Every delivery number, every earnings call, every cryptic tweet moved the stock by billions in a single session. Tesla's market value briefly exceeded the combined value of the world's next several largest automakers, despite building a fraction of their cars. The belief was total that Tesla wasn't really competing with Ford or Toyota, it was competing with the future itself, and the future, investors assumed, only went in one direction. Why Musk's wealth was so exposed. Here's the part most people miss. Musk's net worth was never a pile of cash sitting somewhere. It was an estimate, shares he owned multiplied by whatever price the market assigned them that day. Roughly 3/4 of his fortune sat in Tesla stock, largely unsold, some of it pledged as collateral for loans. He wasn't diversified into cash, bonds, or a dozen unrelated companies, the way many billionaires are. When Tesla's share price moved, his balance sheet moved with it, instantly and violently in both directions. A billionaire whose wealth lives almost entirely in one volatile stock isn't just rich. He's exposed in a way most wealthy people never are. The first major shift. Money became expensive, then the ground shifted. Through the following year, the Federal Reserve raised interest rates at the fastest pace in decades to fight inflation. That mattered enormously for a company priced like Tesla. Growth stocks are valued on profits. Investors expect years, sometimes a decade, into the future. And higher rates make those distant dollars worth noticeably less today. The math that had justified Tesla's soaring valuation started running in reverse month after month. At the same time, higher rates made car loans and leases meaningfully more expensive for ordinary buyers, right as Tesla needed demand to keep climbing to justify its factories and its stock price. Wall Street wasn't just recalculating Tesla's future anymore. It was demanding proof that the future could still be reached on schedule. The EV price, war and margin compression. Underneath that macro pressure, the economics of actually building and selling cars were quietly tightening. Tesla's automotive gross margin, so what it keeps from each vehicle after direct production costs, had been unusually high. A major reason investors treated it more like a software company than a manufacturer. But raw material costs, logistics, and slowing order growth in key markets began squeezing that advantage. Tesla would soon lean on price cuts to protect demand, a strategy that can work, but only by trading margin for volume, selling more cars while earning less on each one. Investors who had priced Tesla for software-level profitability started asking an uncomfortable question. What happens to that premium valuation once the margins look more like an ordinary car company's? Competition catches up. Competition was no longer theoretical either. In China, BYD was scaling production at a pace few analysts had predicted, and by the final months of the year, it had pulled ahead of Tesla in total electric and hybrid vehicle sales worldwide. Legacy automakers were finally shipping real electric competitors instead of concept cars, chasing the same buyers with more models at more price points. None of this made Tesla irrelevant. It still sold more pure electric vehicles than any single competitor, but it quietly undercut the story that Tesla stood alone in its category, and a stock priced for total, unchallenged dominance cannot afford to look like merely one strong player among several rising ones. The Musk factor. Then Musk made it personal. In October of that year, he closed a $44 billion acquisition of Twitter.
The deal is done. Twitter has been sold to Elon Musk.
The social media platform Twitter is now in the hands of the world's richest person.
We'll buy Twitter for $54.20 a share, or $44 billion in a deal that will take the popular microblogging service private.
A deal he had spent months trying to escape, funded partly by selling billions of dollars in Tesla stock at already depressed prices. The distraction was measurable. Engineers, board attention, and headlines shifted toward a chaotic social media platform instead of Tesla's factories and product roadmap. Advertisers pulled back from Twitter amid controversy over content moderation, and Musk's increasingly polarizing public persona began attaching itself to the Tesla brand in ways that were hard to separate from the product itself. Some of this was measurable governance risk, a distracted chief executive and a stock sale under duress. Some was subjective backlash to his politics and public behavior. Investors, rarely patient with either kind of risk, treated both as reasons to demand a discount on the stock. Tesla was selling the future, and yet Tesla's valuation had never rested on cars alone, which is precisely why the story doesn't end with margins and competitors. Musk had spent years selling the promise of what Tesla would eventually become: fully autonomous driving software, a robo-taxi network that could turn parked cars into revenue-generating fleets, an ambitious humanoid robot project called Optimus, and a fast-growing energy storage business selling batteries to homes and utilities. Those bets, largely unproven and years from meaningful revenue, had carried enormous weight in Tesla's stock price. Investors were paying today for products that didn't fully exist yet. That's the trap of a story-driven valuation. When a company's present-day results wobble, investors don't quietly tolerate distant future promises. They interrogate them harder. Every delay to self-driving timelines, every skeptical question about when Optimus would ship, chipped away at a premium the market had once handed out almost for free. Payoff, where the $130 billion went, so add it up, Tesla's stock fell roughly 65% that year, its worst on record, dragging Musk's fortune down alongside it. By year's end, Bloomberg placed his net worth near $137 billion, down from that November peak above $300 billion, and enough of a swing within the calendar year to erase somewhere around $130 billion, among the fastest personal wealth declines ever measured by any tracker. Rank the causes honestly, because the mystery deserves more than one villain. Rising rates, repricing growth stocks did the heaviest damage. Softening demand and rising competition added pressure from underneath, and the Twitter deal converted a market-wide problem into a partly self-inflicted one at exactly the wrong moment. None of it alone would have erased a fortune this large. All of it compounding at once did. Here, finally, is the answer the mystery demands. Musk didn't lose $130 billion in cash because he never held it in cash to begin with. What actually fell was the price the market was willing to pay today for a future Tesla hadn't finished building yet. His fortune had risen at extraordinary speed in the first place because investors bet extraordinarily on that future arriving on schedule. When their confidence wavered, the value of his ownership fell at that same extraordinary speed. Not because the company vanished, not because the cars stopped selling, but because belief, unlike a factory or a fleet of cars on a lot, can be repriced by the market in a single trading day. Subscribe for more stories like this. And tell me in the comments, was this a warning sign or just noise?